Okay, Chapter 18, Part 7, the last part. So the officers of a corporation, they are hired by the board of directors. They're agents of the corporation. Their rights are defined in their employment contracts, and generally they can be removed with or without cause by the board of directors. The board of directors and the officers are fiduciaries and owe that ethical duty to the corporation. The duty of loyalty and the duty of due care. The duty of due care includes the acting in good faith, that is honestly, exercising care that an ordinary prudent person would exercise in similar circumstances, and do what they believe is in the best interest of the corporation. The duty of care also includes the duty to make informed decisions, that is, to be knowledgeable about what you're deciding to do, and to exercise reasonable supervision over employees. Dissenting directors, an individual director may disagree with the majority's vote. That should be recorded. Unless it's recorded, then they're presumed to have assented to it. Now this is an important slide right here. This is one you can expect to be tested on. The business judgment rule. What is the business judgment rule? Basically it says that if you're on the board of directors and you vote on something, and it turns out that what you voted on and you approved doesn't work out, works to the detriment of the corporation, the shareholders cannot sue you if you did so based on this business judgment rule, which means that you acted in good faith and you made a reasonable inquiry. Okay? So you asked some questions. You studied what was presented to you. Okay? So if you've got a corporation that manufactures television sets, and the proposition is brought before the board to branch out and manufacture video cameras, and you vote for that, and you manufacture the cameras and they don't sell, lose a lot of money. If you looked at the paperwork that was given to you and it seemed reasonable, there were studies done about the need for more video cameras, etc., etc., as long as you acted reasonably and did your homework in a reasonable way, you cannot be sued personally just because the decision that was made turned out to be a poor decision. In other words, you don't get to be managed in hindsight. So as long as the decision was reasonable and informed and made in good faith and in the best interest of the corporation, the business judgment rule applies. You have also the duty of loyalty, subordinating your personal interests to the welfare of the corporation. No conflicts of interest, no competition with the corporation, no taking advantage of corporate opportunities that would be in conflict, and that's your duty of loyalty. No insider trading. That means that you cannot use information that you gained from the being a director to profit from that information to the detriment of the general public, either by selling or buying your stock before that information is made public. No transactions that is detrimental to minority shareholders, and no selling control over the corporation. No conflicts of interest. You must make full disclosure of any potential conflicts of interest and abstain from voting in any transactions that may benefit a particular director or officer personally. However, if the transaction was fair and reasonable, it can be approved by a majority of disinterested directors. liability of directors and officers, personal liability for crimes and torts committed and for those committed by employees under their supervision. Shareholder derivative suits are allowed where the shareholders perceive that the corporate directors are not acting in the interest of the corporation. We talked about that before. Okay, let's talk a little bit about shareholders. So shareholders have an equitable ownership interest in the corporation. They generally have no right to manage the daily affairs of the corporation, but do so indirectly by electing the directors. They approve or disapprove of all fundamental changes to the corporation. They have to approve amendments to the articles of incorporation and the bylaws. They have to approve mergers and acquisitions, the sale of all corporate assets, or dissolution. Of course, they elect and remove board of directors. Shareholders' meetings must occur at least annually. There must be notice given to all of the shareholders at least 10 days, but not more than 60 days in advance. Proxy is a good word to think about. Proxy allows people to vote on issues at the board meeting without being present. In other words, you're contracting with somebody to vote for you. Usually somebody who's going to be there, usually somebody who's on the board. There are, by the way, two types of proxies. One is where you tell the person how to vote for you. The other is where you allow that person to use their judgment to vote for you. Okay. So shareholder proposals. Shareholders can submit a proposal to the board of directors and ask the board to include the proposal in the proxy materials that are sent out before the meetings. Okay, shareholder voting, usually a quorum requirement. Usually it's 50%, doesn't have to be. And then usually you are given one vote for every share that you own. Okay, now there's this thing called cumulative voting. And what that means is that, let's say there are 5 seats on the board up for election. And let's say you own 5 shares of stock. And that way you have one vote for each share of stock. Okay, so in seat number 1, you have A and B running. Okay, you would vote for either A or B. Okay, let's say you voted for A. A now has 1 vote. That's regular voting. Cumulative voting allows you to take all 5 of your votes and give them to A. Okay, why is that allowed? The purpose of that is to enable minority shareholders to get some influence on the board. So if a lot of minority shareholders accumulate their votes and all vote for, say, A is going to get elected. Now, they're not going to have much voice, if any. They're not going to have any voice in all the other 4 seats. But by accumulating their votes, they have a good chance of electing A, who's going to then be their voice on the board of directors. Okay. You can also have this kind of voting where you have shareholder voting agreements, where a group of shareholders agree in writing to vote their shares together in a specified manner. It's usually held to be valid and enforceable. We talked about voting by proxy. You can also enter into a voting trust, which is an agreement under which a shareholder assigns the right to vote his or her shares to a trustee, usually for a specified period of time. So most corporations no longer issue written stock. It's all electronically preserved. Preemptive rights are rights that you have in stock that say that if the corporation issues new stock In order for your vote not to be diluted, you have the right to buy an proportionate amount of the new stock to preserve your voting strength in the future. So that's what a preemptive right is. Stock warrants allow you to buy at a stated price. We already talked about dividends. Dividends are how you're paid from the profits of the corporation. Dividends can never be paid out of assets. They have to be paid only out of profits. If the corporation doesn't make a profit, it cannot pay dividends. Those would be illegal dividends. If they're paid from an unauthorized account or cause the corporation to become insolvent. In some instances, if the corporation fails to pay dividends even though they're having profits, shareholders can ask a court to compel the directors to pay a dividend if they show that the directors have acted so unreasonably in withholding dividends that their conduct is an abuse of discretion. That would be highly unusual. Shareholders have the right to inspect corporate records, including voting lists. They have the right to transfer, that is to sell their stock. They can bring a derivative suit. We talked about that before. That's where the corporation has a debt owed to it by a third party but is refusing to take action to collect that debt. The shareholder brings a suit. If won, the profits or the proceeds go to the corporation. Before doing so, they have to make a written demand on the directors. And directors have a time period in which to respond by taking action or by doing nothing, and the derivative suit can go forward. Again, the damages go to the corporation, not to the individual. Majority shareholders can own enough shares to exercise de facto control over the corporation, but they still owe a fiduciary duty to the minority shareholders. Okay, so that brings us to the end of chapter 18. Obviously, I have condensed a lot of this material from the book and from the original PowerPoints. It wouldn't hurt you to look at the original PowerPoints as well as making sure you read everything that's in the book. Again, the magic word for chapter 18 is bylaws.